Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Paramount Skydance.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Right, so to start off today's audio summary.
Yeah, let's unpack this right away. It is Wednesday, February 25th, 2026.
And if you are watching the media landscape today.
Especially the stock market side of things.
Exactly. Today is not just another Wednesday.
It feels like we are standing right on a fault line.
No, absolutely. It is a massive doubleheader.
You don't often get a day where the fundamental reality of a company and its existential future just collide at the exact same moment.
A doubleheader is almost putting it mildly here.
We're talking about Paramount Skydance.
Right.
And looking at the calendar, looking at the sheer volume of news dropping today, I don't think there has been a bigger day for this company since the merger last year.
It is certainly the most volatile moment they have faced in a long time. Because right now, today, we have two massive narratives colliding head-on.
Let's break those down.
Okay, so on one side, you have the bread and butter fundamental reality, which is earnings.
Right. They report their Q4 numbers tonight after the closing bell.
Which is usually enough drama for one day.
Yeah.
That is the report card.
Exactly.
But on the other side, you have this massive existential corporate battle playing out in real time.
The M&A war.
Yes, the M&A war for Warner Brothers Discovery. It is heating up, the bids are flying, and Paramount Skydance is right in the center of the ring.
It's like trying to file your taxes while you're also in the middle of a heavyweight boxing match.
That is a surprisingly accurate analogy. You have the mundane accounting on one hand and a literal fight for survival on the other.
So what we want to do in this audio summary is walk you through exactly what is happening today. Our mission is to figure out if this is a train wreck waiting to happen or if this is actually one of the smartest contrarian plays on the board right now.
And just to set the stakes for you, the market is confused.
I'm very confused.
You look at the sentiment, you look at the price action, and it is messy. But in that mess, there are some very clear signals if you know where to look.
But let's start with that mess.
Okay.
Because if I pull up the chart for Paramount Skydance right now, it does not look pretty.
It has been really rough.
We are seeing the stock hovering around, what, $50 to $13?
Yeah, the recent open was right around $12.95.
Right.
But the trend is the real story here. The stock is down about 33% over the last 6 months.
Wow.
And year to date, they are down nearly 20%.
So if you're just a casual observer or, a disciplined trend trader, you see a red line going down and you think,
Anyway.
Right, don't catch a falling knife.
Exactly.
So why are we even talking about this as an opportunity for the listener?
Because the market is a forward-looking machine, but right now it is looking in the rearview mirror.
At the integration pains from the 2025 merger.
Precisely. What we need to look at is the divergence.
The divergence.
Right. The price is going down, heavily influenced by uncertainty and past friction. But the potential, specifically the strategic position they are carving out, is actually consolidating.
The narrative has shifted literally overnight.
It has.
And that shift is coming from this Warner Brothers Discovery news. Let's dive into the main event, because this isn't just a rumor anymore.
No, this is official. For a while, it looked like Netflix was going to walk away with Warner Brothers.
It seemed like a done deal.
It really did. But Paramount Skydance has just thrown a massive wrench in the gears. They didn't just knock on the door, they kicked it down.
They escalated with a revised all-cash offer.
$31 a share.
$31 a share, all cash.
Which is aggressive.
Incredibly aggressive, especially for a company that is still, digesting its own merger from last year.
It is a huge move, and here's the catalyst that actually matters today.
Okay.
The Warner Brothers board has officially deemed this a potential superior proposal compared to the Netflix deal.
Superior proposal. That is very specific legal language, right? That is not just them saying, oh, that's nice, thanks for the offer.
Exactly. In M&A land, superior proposal is a trigger. It means the board is legally obligated, based on their fiduciary duty to shareholders, to give this serious consideration.
Even if they had a previous agreement with Netflix.
Yes. It shifts the leverage completely. It forces Netflix to either pay up or step aside.
So Paramount Skydance is basically going all in. They are putting all their chips in the middle of the table.
Yes.
But why? Why do they want Warner Brothers so badly?
It is all about scale. We have been talking about this streaming wars for years, right?
Right, and the thesis used to be who can get the most subscribers.
Exactly. But now The thesis is who can build the biggest fortress.
A content fortress.
Precisely. If Paramount Skydance acquires Warner Brothers, they aren't just getting another studio. They are getting a library that rivals, and in some verticals completely exceeds, Netflix.
They become a duopoly player instantly.
It creates a massive moat.
So they are trying to buy their way to the top of the food chain.
They are trying to ensure they don't get eaten.
Mm.
In this landscape, you are either a giant or you are a target.
And they want to be a giant.
They do. And the timeline for all this is really tight.
Extremely tight. This isn't some wait and see next year kind of thing.
No. The shareholder vote is scheduled for right around March 20th, 2026.
That is less than a month away.
Which creates a very specific window for you as an investor. We call it a swing trade window.
Between now and March 20th.
Right. Every headline, every counteroffer from Netflix, every whisper from the board is going to move this stock.
And volatility equals opportunity if you are on the right side of it.
Exactly.
Okay, so that is the corporate battle. That is the house of cards stuff. But we also have the nuts and bolts. We have earnings tonight.
The report card.
Right, Q4 fiscal 2025. It comes out after the close today.
Yes.
Now, usually, when a company is in the middle of a massive bidding war, earnings might feel like just a sidebar. But I have a feeling these numbers matter a lot for their credibility right now.
They matter immensely. Because if you were going to borrow billions to buy Warner Brothers...
You need to prove your current house is in order.
Right. You can't go to the bank for a massive mortgage for a vacation home if you are defaulting on your primary residence.
That is a perfect analogy. So what are we expecting? What is the bar they need to clear tonight?
The consensus forecast is calling for revenue of $8.15 billion. That is up about 2.1% year over year.
Okay, so modest growth, nothing explosive.
Modest, yes.
Yeah.
But the bottom line is where the real story is. They are forecasting an earnings per share, or EPS, loss of just 1 penny.
Minus 0.01.
Yes.
Now, a loss is still a loss, but wait, let's contextualize that. How does that compare to last year?
Right. A year ago, they lost 11 cents per share.
Oh, wow.
So shaving that loss down to almost break even is a massive improvement in operational efficiency. It shows that the cost-cutting from the Skydance merger is actually working.
They are stopping the bleeding.
They are.
And here is a stat that jumped out at me from the notes. They have beaten earnings estimates in 6 of the past 8 quarters.
Which tells you something important about management.
Mm.
They like to underpromise and overdeliver.
The market often underestimates them.
Constantly. So if they come out tonight and post a surprise profit, even a small one.
That stock chart we talked about earlier, the ugly one, could change direction very fast.
It could light a fuse.
Yeah.
It validates the management team right at the moment they need validation the most.
Let's talk about the financial health check, though, because you mentioned borrowing billions.
Yes.
When I look at the trailing 12-month revenue, it is sitting at around $28.73 billion.
That is a big number.
It is, but are they actually profitable?
Well, the forward PE, the price-to-earnings ratio, is sitting at 13.97.
Okay.
That signals that analysts expect profitability to improve significantly in the near future. But right now, on a trailing thesis, they're still posting net losses.
Yet they are still paying a dividend.
That is the fascinating contradiction here.
Right.
Despite the net losses on paper, they are maintaining a 20-cent dividend.
Which is about a 1.5% yield.
Roughly, yeah.
Why would a company losing money pay a dividend? Isn't that like, I don't know, buying a round of drinks for the bar when your bank account is overdrawn?
It seems like it, but it's actually a signal. It is management telling the market, we have the cash flow.
Okay.
Remember, net income on paper includes a lot of non-cash charges, like depreciation and amortization. Cash flow is what actually pays the bills.
So by keeping that dividend, they are signaling extreme confidence in their liquidity.
Even while they navigate these massive integration challenges.
Okay, that makes sense. It's a flex.
It is absolutely a flex. It's saying, we are fine, we can handle this.
I want to pivot back to what they actually sell. Because we talk about a content fortress and scale, but what is actually inside the castle?
Content is king, as they say. But
Yeah.
for Paramount Skydance, it is specifically about proprietary IP.
Intellectual property.
Yes, but incredibly sticky IP.
Say
They have partnerships with the UFC. They have the South Park creators.
I mean, you really can't get much stickier than the UFC or South Park. Right. People don't just casually like those things. The fan base is obsessed.
Exactly. And that creates incredibly high switching costs for distributors.
Meaning, if you are a cable provider or a streaming bundle aggregator and you say, we aren't going to carry Paramount Skydance,
You are going to have very angry UFC fans and angry South Park fans canceling your service.
and you do not want angry UFC fans.
You really don't. And that is the defensive moat.
Right.
That specific content pipeline protects them while they fight these financial battles. It gives them a floor.
Even if the Warner Brothers deal falls apart, they still own the UFC rights. They still own South Park.
Exactly. That has intrinsic value that isn't going anywhere.
But let's play devil's advocate here for a minute. Let's put on the bear hat, because we can't ignore the risks.
No, we have to look at them.
You mentioned the bid for Warner Brothers is $31 a share, all cash. Where is that cash coming from?
That is the multi-billion-dollar question, the leverage.
Right.
To pull this off, the combined entity would have leverage of over 6 times.
6 times leverage. That sounds very heavy.
It is heavy. It is a debt anchor. If the accretion, the growth they expect from the merger, doesn't happen fast enough.
Or if regulators step in and block the deal, sticking them with fees.
Exactly. That debt becomes a massive, massive problem.
It's like buying a mansion with a giant mortgage, banking on getting a huge raise next month. If the raise doesn't come,
You are in serious trouble. And that is why Wall Street is cautious.
the consensus rating right now is moderate, sell, or hold.
Yes. The analysts are nervous about the balance sheet. They see the potential reward, but the risk of that debt load is terrifying to conservative investors.
But you also mentioned that the deal has some protections.
Yes, the counterargument here is that the latest bid includes specific ticking fees and termination fees.
To protect shareholders.
Right. Essentially, if the deal drags on or gets killed, Paramount Skydance has built in some insurance policies so they don't just get left holding the bag.
And looking at the price targets, even with all this skepticism, the stock is trading way below where analysts think it should be.
That is the smart wealth angle we always look for. The average price target is around $14.08.
And the stock is trading near $12.95.
So you have a theoretical 36% upside just to the average target.
And if the merger actually goes through?
Needham suggests the win price could value the company at $34 a share.
Wow. So the risk might already be priced in.
Precisely.
Like, the market is assuming the worst, so the stock is cheap?
It's trading at a discount to disaster.
Let's get technical for a second.
Yeah.
For the traders listening who like to look at the charts and the flows, is there anything cooking in the plumbing of the market?
Oh, the plumbing is very interesting right now. We have a potential short squeeze setup.
I love a good squeeze. Break that down for us.
So short interest is sitting at 49.9 million shares,
Okay.
which is about 4.7% of the float.
That's decent, but not huge, right?
It's not huge in absolute terms,
Yeah.
but you have to look at the days to cover ratio. It's 6.4.
6.4 days. Explain that to the listeners.
Think of days to cover as the size of the exit door in a crowded theater.
Okay.
It measures how many days of normal trading volume it would take for all the short sellers to buy back their shares and close their positions.
And anything over 5 is considered significant.
Right. It means the door is very small.
So if a catalyst hits, say, a surprise earnings beat tonight, or the Warner Brothers board officially signing the deal,
Those short sellers are going to be trapped. They will have to buy back shares to cover their positions,
and that buying pressure forces the price up,
which forces more shorts to cover.
and boom, you get that vertical green line.
Right. And looking at the volume, 23.3 million shares trading, people are definitely paying attention.
The options markets are implying a move of about 1.8% just on the earnings news.
But I think that is incredibly conservative given the M&A context.
So the powder keg is there. We just need a match.
We need a match. And tonight's earnings could absolutely be that match.
Okay, let's wrap this up with a verdict. We have looked at the price, the war for Warner Brothers, the earnings expectations, the moat, and obviously the risks.
Right.
Where do we land on Paramount Skydance?
I think we have to give this a bullish score. I would say a 7 out of 10.
7 out of 10. That is solid.
It is. But I want to be crystal clear about the type of trade this is.
Okay.
This is not a buy and hold for 30 years recommendation necessarily. This is a swing trade.
Target date.
March 20th. That shareholder vote. You are playing the window between now and then.
And what is the core value proposition here for you as an investor?
The value proposition is simple. You are buying a company trading well below its fair value, even without the merger.
Right.
If the merger happens, you get the upside to that $34 level. If it doesn't, you still own a company with South Park and the UFC that is trading at a steep discount.
So you win if they get the girl, and you win if they stay single.
In a way, yes. It is asymmetric upside.
And the immediate catalyst is literally hours away.
The night.
So if you are listening to this before the market closes on February 25th, or even right after, keep your eyes glued to that after-hours tape.
This is high-stakes poker. Paramount Skydance just looked at Netflix, looked at the Warner Brothers board, and shoved their entire stack of chips into the middle.
And as we know, in poker, you don't always need the best hand. You just need the other guy to blink.
Or in this case, you need the Warner Brothers board to realize that cash is king.
True.
But here is a final thought for you to chew on, something we didn't touch on deeply but is lurking in the background.
Lay it on me.
We have been talking about Netflix versus Paramount Skydance. But what if a third player enters?
A third player.
Tech. Big tech.
Like Apple or Amazon.
Exactly. We know Amazon and Apple have been sniffing around media assets for years now.
Right.
And with Paramount Skydance putting a specific price tag on Warner Brothers,
$31 a share.
right, they have effectively set a market price.
They put a sticker on it.
Exactly. So what stops Apple from looking at that and saying, wait, we can own that massive library for $31 a share?
That is literal pocket change for them.
It is.
Oh, that is spicy. You set the price, you might just attract a much bigger shark.
Exactly. The bidding war might just be getting started, and the players might completely change. Just something to keep in mind.
That is a fascinating thought. If Apple or Amazon steps in, this chart goes straight to the moon.
Indeed it does.
All right, that is a wrap on this audio summary for Paramount Skydance. A massive day today, a massive month ahead. We will be watching the earnings print tonight very closely.
Absolutely.
If you find our talks useful, please consider subscribe, like, and comment underneath.